Right now, your money is probably doing one of three things: sitting in a savings account, waiting for the right time, or barely invested because something doesn't feel right. And honestly, that makes sense because everything right now feels uncertain. But here's the problem. If the market feels risky right now, you might be looking at it the wrong way because the investors who build real wealth don't wait for things to feel safe. In fact, they usually invest when it feels the worst. And that's exactly what's happening right now. And once you see why, you won't look at investing the same way again. My name is Sai, and I spend a probably unhealthy amount of time understanding how money actually works in Canada, not the complicated version, the version that actually changes what you do with your money. Because most people don't have a knowledge problem, they have a decision problem. And this video is going to fix that. Quick thing, this isn't financial advice. This is about understanding how the game works so you can play it better. Let's ground this in reality, because context matters more than people think. 2026 has been messy. Rates went up, now they're coming down. Markets are volatile. Housing is still under pressure, and most Canadians feel stretched. And if you're being honest, it doesn't feel like a great time to invest. Everything feels expensive, uncertain, unpredictable. And when things feel like that, most people do the same thing. They wait. And this is where things start to separate, because some people are waiting and others are quietly moving. Waiting sounds smart. It feels responsible. I'll invest when things calm down. I'll wait for the right time. But here's the truth. That moment never comes. There's no signal, no green light, no point where the market taps you on the shoulder and says, okay, now it's safe. And the people who wait for that moment almost always miss what happens next. Because the biggest gains in the market happen when things feel the worst, not when they feel safe. Which means waiting doesn't reduce risk. It just guarantees you miss the upside. And this is exactly where most people fall behind. So if waiting doesn't work, what are smart investors actually doing instead? Because it's not random and it's not complicated, but it is very different. First, they stay invested, but they don't stay passive. Because staying invested doesn't mean doing nothing. It means adjusting without panicking. Smart investors look at their portfolio and ask, does this still make sense today? Not 3 years ago, not during a different economy, today. Because the environment changes, and when it does, your strategy should shift with it. Not dramatically, not emotionally, just intentionally. Think of it like driving. You don't abandon the car when the road changes, you adjust. That's it. Now this is where it gets uncomfortable, because what smart investors do next goes against basic human instinct. When the market drops, most people feel fear. They see red numbers and their brain goes into protection mode. I need to get out. I need to stop this. But smart investors see the same thing and interpret it differently. They see lower prices. They see opportunity. Same data, different reaction. And the reason is simple. Your brain isn't designed for investing. It's designed for survival. And in investing, those instincts work against you. That's why this is hard, and that's why it matters. Now here's something most Canadians are massively underusing, and it's not complicated. It's just ignored. Your TFSA, your RRSP, your FHSA. These aren't just accounts, they're advantages, and smart investors treat them that way. Because where you invest matters just as much as what you invest in. You can make the same investment and end up with completely different results just based on the account you used. And most people, they either don't use them or use them wrong. And that mistake compounds quietly for years. Here's another truth people don't like hearing. You don't need to be smart to invest well. You need to be consistent. Because the data is very clear. Most people don't beat the market, not individuals, not even professionals. So smart investors don't try to win that game. They change the game. They use simple, diversified ETFs. They keep costs low, they stay consistent, and they let time do the heavy lifting. It's not exciting, but it works. And that's what matters. Quick pause, because this part matters more than anything so far. What's actually holding you back from investing? not the surface answer, the real one. Fear, confusion, timing, or just not starting. Because once you know that, everything else becomes easier. Here's the biggest shift. Smart investors remove themselves from the process because the biggest risk in investing isn't the market, it's you, your emotions, your hesitation, your inconsistency. So they automate everything. Money goes in whether they feel confident or not, whether the market is up or down. And over time, that consistency beats almost every smart decision, not because it's perfect, but because it actually happens. Here's something most people never adjust: their time horizon. Most people think in months. Smart investors think in decades, and that changes everything. Because short-term volatility feels dangerous, but long-term, it's normal, expected, even necessary. And when you zoom out, what felt like risk starts to look like noise. Now, this one gets ignored, but it might be the most important one. Smart investors don't just invest in the market, they invest in themselves, because your biggest asset is your income, not your portfolio. And increasing your income often beats trying to optimize your investments. It's not flashy, but it compounds faster than people realize. And here's the part most people avoid: debt. Because sometimes the best investment is paying something off. High-interest debt? That's a guaranteed loss, and eliminating it is a guaranteed return. Smart investors understand that, and they don't ignore it. Now here's what the other group is doing, and this is where it gets dangerous. They're choosing safety, savings accounts, cash, GICs, and it feels good, stable, predictable, but it's quietly costing them. Because inflation doesn't stop, and over time, that safe choice becomes expensive. This might be the most important part of the entire video. Most people don't struggle with investing because they lack information. They struggle because they don't see themselves as investors. They're waiting to feel ready, waiting for the perfect moment. But that moment doesn't arrive. It's a decision. And once you make it, everything changes. So here's what you actually do. Start small, stay consistent, use your accounts properly, automate everything, and stop waiting. That's it. The people who build real wealth don't feel confident when they invest. They feel uncertain. They feel uncomfortable. Sometimes they feel like they're doing it wrong, but they do it anyway. Because they understand something most people don't. Waiting feels safe, but that's where progress dies. So they start. They stay in, and they let time do the rest. You can do the same. Start now. If this helped you see things differently, subscribe, because this is what we do here. No noise, just clarity. I'm Sai. I will see you in the next one.